Matt, let's move on here to a listener question we got on Twitter the other day. And this comes from a listener with the handle @FooleryJoe. I like that, @FooleryJoe. And @FooleryJoe asks, question for the financials episode this week. Do bonds at their current yield have a place in a foolish portfolio? And I'm going to go straight to our resident certified financial planner, Mr. Matt Frankel. What do you think about this question here from Joe Foolery?
I mean, the short answer is it depends. I mean, bonds are it's pretty well known. If you have a good investing background, bonds are also known as fixed income investments.
Mm-hmm.
They're generally designed to produce a steady stream of income without much downside risk to your principal. The reason is because if you buy bonds at the bond's maturity, you get your money back. If I pay $1,000 for a bond from a company, I'll get that back whenever the bond matures. The problem is right now interest rates are so low, they're not paying much of anything.
Yeah.
Especially the high quality ones. If I buy a 10-year treasury, I'm not going to get that much income out of it.
No.
So I think I think they're just over 1% right now on 10-year treasuries. It's better than it was, but it's more of a question of how much preserving your capital is a priority.
Yeah.
If you can afford to survive the ups and downs of a market, let's say you're in your 30s like I am, and you have a few decades left till retirement, you can survive, you can, watch your portfolio go up and down, knowing that you have a diverse collection of good businesses in there. You can have much less in bonds than you would, say, if bonds were yielding 4 or 5%. I know if bonds were yielding what they were, in the 90s, I would have a whole lot more of them in my portfolio than I do right now.
Yeah.
So I think you would feel the same. You would agree with that statement.
I would. Yeah, absolutely.
So it's a question of, but then again, if you're in your 60s right now, and the priority is, if you're almost at the finish line of retirement, your priority is preserving capital, bonds definitely still have a place.
Yeah.
You're not going to get that type of capital preservation in the stock market. You're just not.
Yep.
Even if you're buying like blue chip dividend stocks. Like, think of like the most boring rock solid company you can. Jason, any names come to mind?
Procter and Gamble.
There you go. Look what they did in March of 2020. It was not preserving investors' capital to have money in Procter and Gamble in March of 2020.
No.
So it's a question of capital preservation more than anything. If you're worried about, if you have money that you need, fixed income or bonds still has a great place in your portfolio. But if people younger, a lot of them are going pretty much almost 100% stocks right now.
Right.
And if you're in your 30s and 40s, I really can't argue with that if you're doing it in a diverse, correct way.
Yeah. Yeah. And I mean, it is too, you take into consideration things like if you're a homeowner, the equity that you have in your home. I mean, there are other types of investments that can be a little bit more protective. I mean, I like how you sort of talk about are you in the grow your wealth stage or the protect your wealth stage? Because that really does dictate a lot. And I will say, I mean, I reached into some of our resources here at the Fool and just looking at some of the advice in Rule Your Retirement and the team over there. And this is just sort of a roundabout way of looking at it. I mean, there is context and whatnot to be considered here, but generally speaking, they're looking at this from the perspective more than 10 years out from retirement. Maybe you have 6% of your portfolio in bonds. If you're within 10 years of retirement, maybe you have about 20% of your portfolio in bonds. If you're in retirement, maybe you have closer to 25% of your portfolio in bonds. Again, that's suggested guidance. That doesn't take into consideration where all of your money is allocated. Again, I mean, if you have gold or real estate or anything else, just things to keep in mind. But certainly it feels like the closer you get to retirement, I mean, obviously the more a role they potentially should play.
Yeah, I would agree with that. So yeah, they do have a position in your portfolio, but not as the income generators that they once were.
Yeah.